candidates seeking election always promise more spending. The reality when they get elected, if they've got any sense at all, is to tone that down and try and control the spending and blame it on the last lot, if you like. But I'm not sure that even this modicum of sense is actually in either of the two leading candidates for the coming presidency. I mean, I think President Trump or ex-President Trump, if he gets elected, I think he's going to rely on cutting. I'm just going on what he said. Cutting taxes, corporation taxes, income taxes, and replacing it with tariffs, more tariffs. But I mean, this was what they did in 1930 with the Smoot-Hawley Tariff Act, which killed not only the American economy, but the global economy. So, and then you got Kamala Harris, who is making statements like, we're going to stop price gouging and all the rest of it. I mean, she's going down a route which politicians have gone down. I mean, Diocletian did it. He came out with an edict of maximum prices in about 305 AD. And the result was that nobody in Rome could do any business. I mean, the butchers and the bakers and all the rest of it just shut up shop because they didn't want to get, hanged, if you like, for breaking these rules. So they just shut up shop. And the result was that Rome had to empty because there was no food in Rome. So everybody left and foraged in the country, And Kamala Harris is the last of a very, very long line of politicians who have recommended this sort of policy. Now, again, she could be just electioneering, but I get the feeling that she actually doesn't know what she's talking about. I mean, she is a lawyer, not an economist. You could argue if she was an economist, it would probably be worse with today's bunch of economics so-called experts. But when you get lawyers in charge, they're completely clueless, and this is not good. So, while I would fully accept that, after the election, they deal with reality and the story might be slightly different from what they're telling before the election in order to get elected, I really don't see much hope for the US economy on the election. I would throw in something else, Daryl. I'll throw in something else very briefly. The debt ceiling is due to be refixed. I think on something like the 6th of January or 3rd of January. I mean, literally when the new president takes office. Now, if I was a sort of free spending candidate and I get elected, I want to create headroom. So I want to put the ceiling up as high as I bloody well could. And we're already at 35.5 or something trillion. How about 40?
As we look at the current political landscape in the United States, it's clear that both the leading candidates for the presidency have their sights set on major financial changes. But whether those changes will work in the long term is another story. Historically, politicians running for office always promise increased spending, shiny new programs, and various reforms to capture votes. But as soon as they step into office, reality hits hard. The debt, the deficit, and the overall financial health of the nation tend to overshadow these grand promises. Let's begin with the likely fiscal policies we might see in the next few years and their impact on gold and silver markets. Former President Donald Trump, if re-elected, has suggested cutting taxes further, particularly corporate and income taxes, to boost economic activity. While this may sound appealing on the surface, Trump's plan to replace lost revenue through tariffs is concerning. It's eerily reminiscent of the Smoot-Hawley Tariff Act of the 1930s, which played a significant role in deepening the Great Depression by collapsing global trade. History shows that such aggressive tariffs tend to backfire, leading to retaliatory actions by trading partners and damaging both domestic and global economies. On the other side, we have Kamala Harris, who has expressed populist views like tackling price gouging, a commendable goal on the surface but historically fraught with unintended consequences. Let's go back in history for a moment. Roman Emperor Diocletian in 305 AD tried to combat inflation by issuing a maximum price edict. The result? The Roman market ground to a halt as bakers, butchers, and other merchants simply shut their doors rather than risk the severe penalties for exceeding these artificially low prices. Harris's approach, though well-intentioned, echoes this ancient failure. Price controls often create shortages because producers can't make a profit, so they simply stop producing. This leads to the exact opposite of the desired effect: higher prices through scarcity. For investors, such policies could signal future economic disruption, making precious metals like gold and silver all the more attractive as hedges against failing economic policies. Now let's pivot to the debt trap the U.S. finds itself in. This is perhaps the most significant factor driving the long-term value of gold and silver. The U.S. national debt is a staggering $36 trillion and rising, with projections showing that we could add another $22 trillion over the next decade. The impending debt ceiling discussion, set for early next year, only adds fuel to the fire. Whoever takes office will be faced with the urgent need to raise the debt ceiling once again, likely to $40 trillion or more, just to keep the lights on. But here's the kicker. This unsustainable debt trajectory is one of the primary reasons why inflation isn't just a thing of the past, it's a problem that's here to stay. While the Federal Reserve and government officials downplay inflation concerns, the reality is that budget deficits of this magnitude are inherently inflationary. And the more the U.S. prints money to service this debt, the less purchasing power the U.S. dollar holds. This is where gold and silver come into play. In times of high inflation and mounting debt, precious metals historically perform well. Gold and silver aren't just commodities. They are stores of value that protect against the loss of purchasing power. As the dollar continues to weaken, gold and silver prices will rise, offering a safe haven for those looking to protect their wealth. The problem isn't just domestic, it's global. Foreign countries, which have long been key buyers of U.S. Treasury debt, are increasingly shying away from the dollar. China and Japan, two of the largest holders of U.S. debt, have begun selling their U.S. Treasury holdings, shifting their wealth into more secure assets like gold. This trend is alarming for the U.S. because it signals a broader loss of confidence in the dollar. If foreign nations are no longer willing to buy U.S. debt, the U.S. government will have a much harder time financing its deficits. This will either force the government to raise interest rates to attract buyers, further driving up the cost of servicing the debt, or rely more heavily on the Federal Reserve's money printing machine, exacerbating inflation and reducing the dollar's value.
I mean, first of all, I just want to correct what happened in the great financial crisis is that everybody went for safety. Now, in those days, safety wasn't gold, safety was the dollar. And the result was that gold fell from over $1,000 an ounce down to, I think, something like $680, really quite quickly. But, once that initial shock had passed, gold started powering up, and it was hitting new highs for the next 2 years and ran up to a high of 1924, something like that. I think that was September 2011. So this is fundamentally different. Now, you're right, we don't have a visible crisis at the moment, but there are a number of things in the background which, just because it hasn't sort of hit the headlines, we are aware that there are problems. We look at the central bank's balance sheets, they're heavily into negative equity. We look at the situation for the commercial banks, they are highly leveraged and therefore vulnerable to any shock. We have inflation is a continuing problem. And if you look at the budget deficits, and particularly if we get a downturn in the economy, they're just going to run away. I mean, and that is the source of inflation. Another source of inflation, of course, is excess consumer spending. And if you look at what the consumers are doing, they've tapped out their savings and, they've increased their credit card debt. So basically, everything is still driving prices higher, even though the economy is in if you like, not very good shape. So overall, on that side of things don't look that smart. And then if we go internationally, you can see that the dollar has a problem because the Chinese and the Japanese are no longer buying US Treasury debt. The Chinese in particular are doing what I've just said the hedge funds are now doing in America. They've been selling dollars. And guess what? They've been buying gold. And so have the Chinese citizens, so have the Indian citizens. Now, I think that's died down a little bit now, but it's the idea that the U.S. Treasury is going to be able to fund itself from foreign demand, forget it. That's not going to happen. It really is not. Now, this means that the US Treasury are in a debt trap. And we can see this. So, okay, we don't actually have a visible, sort of huge, great Lehman moment, but we can see that there are these problems. You've got the problem, and it's a huge, great problem with the Middle East, because if Iran gets into this, they'll close the Straits of Hormuz, and then the price of oil is, well, think of a figure and double it. I mean, we could be looking at $200 a barrel easily. So, that's not a sort of shock that we actually want. And I think this is why, actually, the Allied forces, NATO, America, Britain, whatever, are holding back and desperately trying not to get sucked into this conflict. So that's roughly where we are. I mean, there all these huge, great problems. We know the problems are there. We know that the foreigners are no longer buying US treasuries. And perhaps, while foreigners understand that the US government is in a debt trap from which there is really no escape other than really slashing government spending way down. I mean, surplus immediately next year. That's the only way out of this. On that basis, foreigners, I think, some of the institutions, some of the investing institutions, hedge funds and so on and so forth in America are actually getting worried about this funding problem. They can see it.
As we move further into a period of heightened economic uncertainty, it's important to understand the intricate relationships between oil, inflation, and the US dollar's fragility. Oil is not just a commodity, it is the lifeblood of the global economy. Nearly every sector, from transportation to manufacturing, is heavily dependent on oil, which means that any significant shift in oil prices can have far-reaching economic consequences. In particular, geopolitical events in the Middle East, a region responsible for a significant portion of the world's oil production, can send shockwaves throughout the global economy. Let's consider a scenario that has been on the minds of analysts: a potential disruption in the Strait of Hormuz, one of the most critical choke points for global oil supply. The Strait of Hormuz, located between Iran and Oman, sees around 20% of the world's oil pass through its narrow waters each day. A military conflict involving Iran could result in the closure of this vital shipping route, causing an immediate spike in oil prices. Some estimates suggest that oil could reach $200 per barrel or higher in such a scenario. Why is this so significant? Because when oil prices rise, the cost of virtually everything goes up. Transportation costs surge, affecting the prices of goods and services across the board. Manufacturing costs rise, leading to higher prices for finished products. Even agriculture is affected, as farming equipment and transportation of crops become more expensive. In essence, when oil prices spike, inflation follows closely behind. For consumers, this means a loss of purchasing power. Your money simply doesn't go as far when prices for everyday goods and services increase. Inflation acts like an invisible tax, eroding the value of your savings. And while central banks may try to combat inflation by raising interest rates, they are often behind the curve, especially when inflation is driven by external factors like rising oil prices. Here's where gold and silver enter the picture. Unlike fiat currencies, which lose value in times of inflation, precious metals tend to hold their value, or even increase in value as inflation rises. This is because gold and silver are real assets, meaning they are not subject to the same devaluation pressures as paper currencies. When inflation accelerates, investors flock to gold and silver as safe havens, driving up their prices. If oil were to hit $200 per barrel due to a geopolitical crisis, the resulting inflation could be severe. The Federal Reserve might attempt to raise interest rates to combat inflation, but this would come at a cost: higher borrowing costs for consumers and businesses. This in turn could trigger a recession as economic activity slows down. In such a scenario, gold and silver would likely surge in value as investors seek protection from both inflation and the economic downturn. Another key factor in this equation is the fragility of the US dollar. The US dollar has long been the world's reserve currency, meaning it is widely used in international trade and held by foreign central banks as a store of value. However, the dollar's dominance is increasingly being challenged, particularly by countries like China and Russia. These nations are actively working to de-dollarize their economies, reducing their reliance on the US dollar in favor of other currencies and commodities, most notably gold. For instance, China has been steadily increasing its gold reserves while decreasing its holdings of US Treasury bonds. This shift away from the dollar and toward gold reflects a broader lack of confidence in the long-term stability of the US economy and its currency. One of the primary reasons for this declining confidence is the explosive growth of US debt. The US national debt now stands at a staggering $36 trillion, with projections indicating that it could reach $50 trillion within the next decade. This debt burden is unsustainable, and it raises serious questions about the future of the US dollar. Foreign nations, particularly China and Japan, which have historically been large buyers of US debt, are beginning to reduce their exposure to US Treasury bonds. As demand for US debt decreases, the US government will be forced to offer higher interest rates to attract buyers. However, this will only exacerbate the debt problem by increasing the cost of servicing the debt. At the same time, as foreign demand for US debt declines, the Federal Reserve may step in to fill the gap by purchasing more Treasury bonds. But this would involve printing more money, which would further devalue the dollar and contribute to inflation. In other words, the US is caught in a debt trap from which there is no easy escape. As confidence in the dollar erodes, countries around the world are increasingly turning to gold and silver as stores of value. These precious metals are not tied to any one nation's economy or fiscal policy, making them ideal assets in times of global economic uncertainty. In fact, central banks around the world have been on a gold-buying spree in recent years. In 2023 alone, central banks purchased over 1,150 metric tons of gold, the largest annual total in over half a century. This trend is expected to continue as countries seek to reduce their exposure to the US dollar and build up their reserves of real, tangible assets. For individual investors, this global shift toward precious metals presents a unique opportunity. As central banks accumulate gold and silver, the prices of these metals are likely to rise. And as more people lose confidence in fiat currencies, the demand for gold and silver as hedges against inflation will increase. But it's not just central banks that are driving demand for gold and silver. Institutional investors and hedge funds are also beginning to wake up to the reality that fiat currencies are losing value at an alarming rate. In recent months, we've seen a surge in ETF inflows into gold and silver, signaling that large investors are positioning themselves for the next phase of the precious metals bull market. The commercial real estate crisis, another catalyst for precious metals. In addition to the broader macroeconomic and geopolitical factors at play, there is another looming crisis that could send gold and silver prices soaring: the commercial real estate market. The COVID-19 pandemic fundamentally changed the way businesses operate, with many companies adopting remote work models and reducing their need for office space. As a result, the commercial real estate sector is facing a slow-motion collapse. Office buildings in major cities are sitting empty, and property values are plummeting. Many commercial real estate loans are now underwater, meaning that the value of the property is less than the outstanding loan balance. This could lead to a wave of defaults in the commercial real estate sector, which would have serious repercussions for the banking system. Banks are heavily exposed to commercial real estate loans, and a surge in defaults could threaten the stability of the banking system. This would likely trigger a response from the Federal Reserve, which might once again step in to bail out the banks. But as we've seen before, this would involve printing more money, further devaluing the dollar, and driving up inflation. For investors, the implications are clear. The combination of rising inflation, a weakening dollar, and a potential banking crisis makes gold and silver highly attractive assets. In times of financial turmoil, precious metals have historically provided a safe haven for investors, and this time will likely be no different. As we look ahead to 2025, the outlook for gold and silver is extremely bullish. The combination of geopolitical risks, domestic fiscal challenges, and the global shift away from the US dollar all point to a major revaluation of these precious metals. If oil prices spike, inflation accelerates, and the dollar weakens, gold and silver will likely see significant price increases. In fact, Some analysts predict that gold could reach $3,000 per ounce by 2025, while silver could easily surpass $50 per ounce. But even these estimates may be conservative. As more investors recognize the inherent weaknesses in fiat currencies and the growing demand for gold and silver, prices could go much higher. The next few years could see unprecedented demand for these precious metals as the global financial system undergoes a seismic shift. For those who are prepared, this represents a once-in-a-lifetime opportunity. By investing in gold and silver today, you can position yourself to not only protect your wealth, but potentially see significant returns as the world wakes up to the reality of the coming financial storm. The time to act is now, before the rest of the world catches on.